Tēnā koutou katoa, good evening and a warm welcome to all of you who've joined us from around the country. My name is Helen McDowell. I'm the Head of Investment Funds and Business Development for MAS. Tonight, we'd like to offer you some insights as to how we're positioning our funds during uncertain times in these global financial markets. As you, I'm sure, all know, we're currently going through an extended period of market volatility, which can mean sharper and more frequent fluctuations in the value of your investments. Due to a range of factors, including inflation and geopolitics, it's possible that we could see continued volatility for some time yet. In times of market volatility, there are risks, but of course there are also opportunities for investors. Our investment managers are active managers, which means that they can respond to rapidly changing market conditions and they can target assets that they believe are best placed to outperform. Our discussion tonight will focus on how we're investing to protect and grow your money. If you've got any questions during our presentation, please do type them into the Q&A section on Zoom. In a short moment, you'll hear from Phil Borkin. Phil is a Senior Investment Strategist at JB Were. Phil is a key advisor for MAS, and he's an expert on investment market cycles. Phil's going to update us on the state of investment markets, both here and overseas. He'll provide insights as to how the current market environment compares to previous cycles and how long these conditions could continue. Finally, he'll explain how our portfolios are positioned to respond and to succeed in this volatile climate. After Phil, we'll talk to Jules Riley. So Jules is filling in for Crystal, who's unfortunately feeling unwell today. Jules is a senior manager in the investments team, and he specialises in responsible investment while also supporting our team of MAS advisors. Our advisors are based all around the country, and members have free access to their expertise if they would like to get some information or advice on MAS investments or insurance. All of our advisors are salaried professionals. They don't earn commission, which of course helps ensure that their advice is aligned to your interests. Lastly, for the final 20 minutes or so, we'll open up the floor for your questions. And Phil, Jules, and I will do our very best to answer them. We'll sign off at 8 o'clock. In the meantime, I'm really hoping that this will be a lively hour of discussion. So, Phil, over to you. Take centre stage for the next 15 minutes or so. So welcome, Phil.
Thank you, Helen. And it's an absolute pleasure to be here this evening. So my intention today is, as Helen says, there's a lot of volatility and turbulence in financial markets at the moment. My intention is to talk about why that's happening, what we think is going to happen in the future and what we're doing within the MAS funds to counter that. And then I also want to spend some time talking about the long term. Talking about the long term is probably one of the most important things with investing. And so I want to kind of take some of my own medicine and focus on some of those long-term themes, which we're already starting to position within the MAS funds. So I have some slides here now. Usual legal disclaimer, what I say today is not personal financial advice. So you can read over that in your own time, I suppose. But I like to set the scene with this slide. Now, I know it's a busy slide, but effectively shows on the left-hand side how financial markets have fared year to date. And the bottom line is pretty well. On the right-hand chart shows how things were last year. And it's fair to say, let's not sugarcoat it, it wasn't easy. The main reason why it was so hard in financial markets is that there was very few places to hide. If you look at that right-hand chart, effectively, you really needed to be invested in energy stocks or the US dollar to even eke out any sense of positive return. Now, one of my major beliefs for financial markets is that they're pretty efficient about pricing what they can see just in front of them in the immediate future. We're talking a few months. They're not so good at pricing things long term. So to get price action like we see on those two charts, certainly not much fun last year and off to a better start this year, markets need to have been surprised. So I want to just to dwell on that for a second. I think the surprise is going to be a theme that runs through a few of my slides. Markets are pretty efficient about pricing what they see. To get big movements in asset prices like we've seen recently, there needs to have been surprises. So last year, when we think back, why was it so tough and turbulent in financial markets? And sticking with that surprise theme, it was negative surprises galore. Whether it was geopolitics, central bank aggressiveness, growth, inflation, you name it, the surprises were all negative. And it's effectively what these two charts are showing. So the left-hand chart, and I know it looks like a bit of a cobweb really, but on the horizontal axis is a manufacturing PMI, which is effectively a proxy for economic growth. The stronger the number, the stronger economies are. On the vertical axis, headline CPI inflation. So we all have familiarity with that. We started the year in 2022 in that bottom right-hand corner. Economies were growing relatively strongly and inflation was relatively low. But as the year went on, we followed that red line. Growth deteriorated and inflation rose. You might hear economists talking about stagflation. Now, I don't think we're in a stagflation environment, but that type of surprise and shock was stagflationary in its nature. And if I was asked what's the worst combination of macro conditions for investing, it's that. Weaker growth, high inflation. It's very unfavorable and like I said, very few places to hide. Not only that, the right-hand chart shows what central banks did. And again, this is probably equally, if not more important in terms of the market reaction we saw. It shows what the market was pricing in or what it expected for interest rate hikes for the Fed, so the Federal Reserve, the US Central Bank, last year. Let's go to January 2022, so the start of last year. As you read that chart, the market was thinking that to control inflation, to keep employment on a sustainable footing, the Fed would need to hike by around 100 basis points or 1%. So take interest rates from zero, effectively, to around 1%. In the end, the Fed delivered 425 basis points of tightening, over 4%. After the 1980s, it's probably the second most aggressive tightening cycle ever, and it came as a surprise. This is the reason we saw such kind of horrendous market price action last year. But jumping forward to today, like I said at the start, things have got off to a better footing. Now, why is that? Well, again, that surprise theme is going to jump through. Why have markets done better? Well, economists and markets have been surprised positively. That left-hand chart shows inflation surprises. So effectively, the higher that number, the more economists are being surprised by inflation releases. The lower that number, downside surprises. Now, I wouldn't say inflation's surprising markets and economists on the downside at the moment, but it's coming in closer to expectations, which, hey, that's a nice thing. So it's like inflation might still be 6 or 7%, still far too high, but if that's in line with expectations, then markets are taking some comfort from that. Not only that, but we've seen some big positive growth shocks. China has reopened from its COVID lockdown restrictions far more rapidly and in a broad-based fashion than most commentators expected. And we've also seen Europe avoid some of the kind of very negative scenarios around blackouts and a big energy crisis because of a mild winter that they've recently had. So Europe's actually experiencing stronger growth than expected. And that right-hand chart is showing what economists, their forecasts for GDP growth in those regions for this year, how they've tracked. Now, you can see there that they're not forecasting much in the way of growth, but the most important thing is they're starting to revise them upwards, again, because they've been surprised positively by recent developments. Now, when we think about whether this positive vibe in markets can continue, sorry, just having some technical problems with the slides. Oh, we just go back one, sorry, there we go. Can this positive vibe in markets continue? I think the answer to that, of course it can, as long as those positive surprises continue. So what would they look like? Well, it would be inflation falling rapidly or faster than expected. It would be growth continuing to surprise on the upside, which is possible, absolutely. There are scenarios where those could eventuate. But what we would say at the moment is that when we look at equity markets, especially in some regions, there's less room for disappointment. And what do I say that for? Because valuations are getting to levels where they're starting to look relatively rich. And this is what this chart is showing. We all probably have to go back to our kind of intermediate stats classes and look at these box and whisker. Remember what a box and whisker chart shows, but it effectively shows the range of price to earnings multiples, which is a very common valuation metric for equities, and how current valuations track versus their recent history. And I'll single out there the US, which is the second bar in there. That red dot shows that the US equity market's trading on around 18 times forward earnings, which looks expensive relative to its own history. Not as expensive as it has been, but certainly not cheap. And so what we're doing within the portfolios is starting to tilt away from these more expensive markets as a way to help cushion some of the risks that are out there. Now, valuations on their own are actually a terrible market timing tool. If an asset price is expensive today, chances are it's going to be as expensive, if not more expensive tomorrow. But what valuations do highlight is how markets will react to any surprises. If they're expensive, the risks of a negative surprise creates the chance that the price action will be larger on the downside because of that. So we're very mindful of valuations at the moment. So can this vibe continue? Yes, it can, absolutely. The data needs to justify it though, and like I said, we're starting to get to the point in some markets at least where there's not a lot of room for disappointment. Now, what could go wrong then? And I think if I was to be asked what's the most important slide in my presentation, I'd say it's this one. We started this year really with three main questions. Where inflation was going. Now, we have got a strong view that it is easing off its highs, but what we don't know is where is it going to settle? Is it going to fall from 8% to 4% pretty easily? I'd say yes. But can it get from 4% and halve again to 2% very easily? We don't know the answer to that. And because of that, we don't know how hard central banks still have to work. And because of that, we don't know how much of the growth trade-off is required for central banks to get on top of inflation. And why is this chart important? Well, it shows the US labour market in one chart. Now, don't dwell on the fact that it's the US. I could throw up a very similar chart for New Zealand, Australia, any developed country effectively. But it highlights how tight labour markets are at the moment. The red line is total labour supply, the labour force participation rate, the number of workers that are available and are willing to work. The blue line is total labour demand, so the number of people who already have a job and the number of vacancies or job openings that firms have. And if you've got eagle enough eyes, you can see there that the blue line is well above the red line. And this is for the US, but again, like many countries, it's the case. And that is very unusual. In fact, at its peak, on this measure, the US labour market has never been tighter. For every unemployed person in the US at one point, there were 2 jobs available. So remarkably tight. Now, I'm sure we've all got some economics knowledge, particularly around demand and supply. When demand is exceeding supply, we all know what happens to prices. And what's the price of labour? It's wages. And wages around many countries are growing at multi-decade highs. Now, that's obviously wonderful if you have a job, especially to help counter the cost of living pressures we're facing. But it's not consistent with central banks getting on top of inflation. So central banks need labour markets to cool. They can obviously do that through slowing economies down aggressively or firms reassessing their hiring plans. So, and you're starting to see that now when you dig into the weeds of inflation data. And that's what these next 2 charts are showing. Left-hand chart, US CPI data, right-hand chart for New Zealand. And the price pressures are starting to move away from goods, which were pushed significantly higher during the pandemic with supply chain problems and lots of households buying new DIY equipment or electronics or new cars. And it's morphing into services. So the cost of eating out, the costs of going to anything involving labour. And you can see that, the darker lines there are the goods prices, the others are services. And this is related to the labour market. It's sticky inflation, it's potentially persistent, and it's one of the reasons why, yes, we think inflation's likely to moderate from its highs, but we're still not sure whether it's going to moderate all the way back to central bank targets. And because of that, it's far too early to say central banks have won that battle. And I know it all sounds pretty tough. And bottom line, it is. It is pretty uncertain out there. And again, history teaches us that as well. And this next slide, looking at data, again for the US equity market, because we have such a long database of quality data there, how the S&P 500 has behaved when inflation peaks. And that's that middle line there, that 0 month. Inflation peaks, what does history tell us about what can the equity market do beyond that? And the answer, from this chart at least, is, well, it could do anything. And that is the nature of investing, right? There's so many different scenarios and unknowns, but we can distill down into some certain common themes running through all that historical evidence. And basically, I'd focus on the red line and the yellow line. If once inflation peaks in the US, which I believe it has, the US avoids recession, history tells us that equities markets, on average, do very well, or the US equity market at least. In fact, over the next 12 months, adds on average 20%. If growth holds together, inflation's peaked. On the other hand, if inflation peaks and growth or the US economy falls into recession, which would then impact on corporate earnings, you can see that the equity markets would potentially face more pressure. So everything from here on in still just hangs on where inflation's going and how much do central banks need to slow economies down to get on top of it. So how the heck do you position a portfolio to counter all that uncertainty? And the answer is, well, you do not rely on one or the other happening. You create a portfolio that can weather either happening. And that's the kind of the beauty of diversification. And it's also about not relying on one or another scenario. It's assessing the probabilities and tilting portfolios based on how those probabilities may be altering. And when we look at the world at the moment and how tight labour markets are, and I haven't even mentioned recent volatility around the banking sector in the US, we think that the risk to global growth, unfortunately, is still skewed to the downside because central banks still have more work to do to get on top of inflation. So how are we positioning within the MAS funds to counter that? So within equity portfolios, we want to be in position in places where we have confidence in the companies or those sectors' earnings and margins outlooks. It might be in an industry which is more less sensitive to the economic cycle, or a company that's got very sound management or very strong balance sheet, very good margin or margin resilience or pricing power to be able to weather anything that the economy throws at it. From a broader asset allocation, we'd also argue that there's now far more options. Now you see the title there is From Tina to Tara. Now this is not talking about a couple of my ex-girlfriends, but it's around the options that investors have when they're looking for sources of return and income and countering risk. If we think back, 2 years ago, when interest rates around the world were zero, you couldn't get any return on your income from having money in a term deposit or on a bond. There was a saying around the market called TINA. There is no alternative to equities. Investors were forced into equities or into other higher risk assets to find that return. Now, that's no longer the case. We're now in an environment of TARA. There are reasonable alternatives. So you look on just that left-hand chart alone, the return you get on cash, putting your money on call at a bank, so relatively risk-free, 5%. That's very, very different to two years ago. It's the same when you look out in other defensive asset classes, fixed interest bonds. You can get, there's quality corporates issuing bonds in New Zealand now with coupons of 6%, 6.5%. You can get an ample return without taking undue risk. And so this is fixed interest as an asset class that we like. And so from an asset allocation perspective, we've also tilted towards these safer, traditionally defensive asset classes as well. Now, I did say I was going to focus on the long term, so I want to do that in these last two slides as well. The long term matters, like I said, it's probably the most important thing. But market cycles can vary very differently depending on the macro backdrop. And what's been quite remarkable this kind of last cycle, so I'm thinking post-global financial crisis up to the pandemic, is we've been in a very benign economic situation. Relatively benign geopolitical risks, very low and stable inflation, falling interest rates on average, very modest economic volatility. It was a very good environment for business. If you were sitting around that board table or the budget table thinking about whether we need to hire those extra 10 staff or deploy that capital to build that new factory, you have a fair idea about what your cost of capital was going to be, what inflation was going to be, how much wages you'd be needing to pay in the next few years, whether economies were going to be on an ample footing. That decision made it pretty easy. Profit margins got boosted, and as you can see on the right-hand chart, it was a very good environment for equity markets. So these are very long-term charts going back over 100 years. So if you look back on that right-hand chart looking at the US equity market, there's been 3 secular bull markets in the post-war period. Kind of the rebuild after the World War II, then you had kind of the late 1990s leading up to the dot-com bubble in the early 2000s, and then that post-financial crisis period. Now, they all had their unique elements to them, but what was common themes running through all of them is economic growth was either very strong or inflation was low and stable and interest rates or bond yields were generally falling. And in the latter scenario, so that latter cycle, the post-financial crisis period, it was really around low and stable inflation and falling interest rates. That provided a very powerful backdrop for equity markets. What you might also notice about that chart is that you go through periods in between those secular bull markets where some of our research partners call it a fat and flat market. You get lots of volatility, so there's ability to get returns. It is no longer a big kind of the tides rising all ships type of market, and it's a very different type of macro backdrop. And when I think about what the world could look like, say, beyond the next couple of years, so let's assume central banks have got on top of inflation, what the world will look like on average over the next 10 to 15 years, I've listed a couple of things here. And I probably won't go through all of them, and I know it's, again, a bit of a busy slide, but what I think about some of the macro forces that are going to dominate, well, we've got aging populations, so labour forces are shrinking. We're already struggling to find staff now. I think labour is going to become an increasingly scarce resource, as well as commodities. The world needs to decarbonise. We need to source commodities to help with that effort. So that's a cost. Not only that, we've been in a very benign geopolitical backdrop. It probably goes without saying, given events in Europe at the moment. But the world, on average, I suspect, is going to be more volatile. Geopolitics is going to dominate. Why is that? Well, countries are competing for these resources that are quite scarce around the world. Related to that, we're going to be in a more regionalisation type backdrop, rather than this broad deglobalisation world we've been in, which has been very powerful for company profit margins. Firms are going to have to focus on where they have more confidence in their supply chains. The last few years, I'm thinking back to the trade wars between the US and China, and then clearly COVID, supply chains have not held up to scratch. They've been stressed and they've failed. Companies need to build more resilience within those supply chains. That might mean onshoring production or changing where they source products to have more confidence in the political backdrop or the resilience that they're getting access to. Again, that's a cost. So I think on average, when I think about the next 10 or so years, relative to the last 10, I think it's safe to say we're expecting higher inflation on average, because of that, higher interest rates on average, and more volatility in general. So what does that mean for portfolios then? And I know that might sound a bit scary, and probably there are going to be risks to manage, but I think it means that the investment textbook matters again. The last cycle, it didn't. Diversification didn't matter, valuations didn't matter, asset allocation didn't matter. To get the best risk-adjusted returns, all you needed to have done, in hindsight of course, is invested in the US tech sector. That is, I suspect, not going to be the case going forward. I think investment 101 is going to matter again. Valuations are important, so what you pay for your investments is important. Diversification is going to be important, and having that optimal asset allocation is going to be very, very important as well. And that's clearly a hallmark of MAS's current approach. I also think rather than outright earnings growth, which was again what the US tech sector was all about this last cycle, investors are rather going to value earnings stability margin stability. If you're in a volatile world, you want to know if a company's growing at 5 or 10% per year, they're going to continue to grow at 5 or 10% per year. Investors will value that stability. I also think we're going to be in an environment with less tailwinds for passive or index-based investing. When you think back to the last cycle, very powerful secular bull market, lifting all stocks. Very easy just to track an index and not really have to worry about where you should be positioned. In a more volatile world where things are moving rapidly, where there's much more dispersion in what companies are doing well and what aren't, that speaks to less tailwinds for passive investing and perhaps more benefit for active investing. And I know, again, it all sounds deep and dark and not that flash, and I don't want that to be the message. I think it's also important to realise at times of turbulence and risks, that usually is what spurs innovation. If we think back to the 70s, some of today's strong companies actually emerged out of the big inflationary period of the 1970s. And so putting my investment hat on, when I think about a world struggling to find labour or resources, needing to decarbonise, geopolitical tensions, I think opportunities. So I think automation and robotics to help counter the scarce resources. I think of companies that are helping the world decarbonise. I think of cybersecurity and digitalisation companies that not are just related to the tech sector, but are helping industrial companies better manage their own data and processes. And rest assured that we're actually already positioned within some of these themes within the MAS funds. And I think as we get through this next uncertain, volatile period and opportunities arise, that will be our hunting ground to try and position the portfolios for this macro picture that I've presented over the long term. So I'll leave it there. Thank you, Helen.
Fantastic. So look, I think that was a fantastic, thought-provoking presentation. Thank you so much. I'd now like to bring Jules into our discussion. So as I mentioned before, Jules is a senior member of the investments team here at MAS. He's really experienced in helping members make informed decisions about their money. So we thought we'd ask a few questions of Jules that are typical of what our members ask their advisors and ourselves. So first question is, so how could a MAS advisor, Jules, help with your KiwiSaver account?
Of course. When it comes to your KiwiSaver, a MAS advisor can help you understand your investment timeframe, your tolerance for risk, and as well as ensuring you're maximising your government and your employer entitlements within KiwiSaver. It's really helpful to have this service, especially in times of volatility, because it means you have someone to call on. It means you have someone between your emotions and your money, which means that you can access advice to make sure that you make the best decisions for your money and for your investing. And that's why we have around 40 advisors across New Zealand. And all our members have free access to them, and they're here for your benefit. So please, I would really recommend you get in touch if you have any questions and you'd like to learn more about MAS investment products or MAS insurance products.
Fantastic. Thank you so much. So tell me, thinking about myself as a member, so what should I do if the value of my investment fell? Should I switch to something more conservative?
That's right, and this is a question that we get increasingly more commonly in volatile markets. Now, it is really unsettling to see the value of your investment fall, but it's also important to remind yourself that this is a normal part of the cycle, and we've seen this over the last couple of decades, notably in 2002 with the dot-com bubble, the global financial crisis in 2008, and during COVID as well in 2020. But despite all these crises, share markets have continued to rise over time, albeit with plenty of bumps along the way. But one of the most important things you can do yourself to manage volatility is by ensuring that your investment goals align with your investment timeframe and your tolerance for risk.
Okay, yeah, that makes sense. So tell me, why do you think it's important for me to set, or for our members to set an investment goal?
Well, especially for KiwiSaver, right? Because with KiwiSaver, you only really have two goals, and it's either your first home or it's your retirement. Now, once you know what your goal is, you can set your time frame. So say, for example, you're 25, you want to buy a house at age 30, your time frame is 5 years. If you're 40, you've already bought your first house, you're now saving for retirement, your time frame is probably around 25 years until you're 65. So now that you've got your time frame, this clarity helps you understand what sort of fund you should be in. So as a very general rule, if you're investing for more than 10 years, you should consider a growth or aggressive or even global equities fund. If you're investing for 5 to 10 years, you could consider a more balanced fund. And if you're investing for less than 5 years, you could consider a more conservative fund. So that's investment time frame. So really important stuff. And the second thing is your risk tolerance. So this is the other key factor. And now risk tolerance is sort of best described as sort of the saying goes, it's the difference between getting rich and getting sleep. So if you can't stomach any losses and you're prepared to take lower returns as a result, then you're a more conservative investor. Whereas if you're willing to take some volatility in order to achieve higher returns over the longer term, then you're a more growth-oriented investor. So we've actually created a great tool for all our MAS members to use on the website. It's called the Fund Finder. It's new. It just came out last week, and it helps investors answer a few questions and understand both their risk tolerance and investment time frame and match that to the most appropriate fund.
Awesome.
Yeah.
That is very cool. And I would encourage everyone out there to have a go. I had a go myself. Balanced was my answer. But it's a really useful tool.
It
so
is.
Please do go and have a look on mas.co.nz. So we've got lots of market volatility, as we've been talking about. How could I, as a member, protect my investments against future market volatility, Jules?
Well, Phil touched on it before, and the key point to, or one of the key points to preserving your capital is through diversification. Now, diversification is investing in lots of different assets, so it helps you offset losses in one asset with gains from other assets. Now, New Zealanders aren't necessarily particularly good at this with our own money, so we have around $90 billion invested in KiwiSaver, just slightly over $200 billion invested in term deposits, or bank deposits, I should say, but well over $1.5 trillion invested in residential real estate. So these numbers sort of suggest that we're investing, the average Kiwi, 15 times as much money into one house, on one street, in one city, in one country, than we are into our KiwiSaver accounts, which are typically invested in hundreds of companies and dozens of industries in lots of countries around the world. Our schemes, for example, the KiwiSaver Retirement Savings Scheme, invests in about 2,500 assets in almost 50 countries.
Wow, that is diversified.
It is.
That's awesome. So how often do you think that I should review my investment strategy and potentially make changes to it if something's changed?
Well, the best advice tends to be regularly. So you ensure that your fund choice remains aligned to your investment goals and your time frame and your risk tolerance, but not too frequently, because you don't want to let recent events or market volatility affect what should be a really important decision. You don't want to be frequently changing that. So that's sort of how I think about it.
Yeah. So sort of annually.
Yes.
Also.
Annually is probably a good frequency.
Yeah.
That's right. Or after, say, a big event, say you've just bought your first house.
Had a child.
That's right. But especially with KiwiSaver, if you've just bought your first house, you've probably been in a more conservative fund before that, saving in the few years before buying your first house. And now your goal has changed, because now retirement's your goal, and now you probably have a few decades to retire. So that could warrant a different fund choice.
Yeah, that makes a lot of sense.
Yeah.
So I've got children. So should I be setting up a KiwiSaver account for my children?
Well, you could do. And I have a small child too, and this is something that I've done. And it is a really good way to help them save for their first home or retirement. Two reasons. One is compound returns over a long period of time. Second reason is tax. Now, KiwiSaver is a PI. So it means you get taxed at your PIR tax rate, which is personal. Now, if you're earning money over $48,000 a year, then you're likely going to be taxed at 28%, which is pretty standard. Now, if you have a child, because they're not earning or earning less than $14,000 per annum, then they're likely going to be taxed at only 10.5%. So this is much more tax efficient to save under their name than it is under your own name over 18 years and then give them money in the future. And the difference tax can make over time can be pretty large. So just like we talk about compounding returns, that tax has that same effect as well. So if your fund, say, earns 7.5% per annum after fees, if you were taxed at 28%, that would be 5.4%. But if you were taxed at only 10.5% as your child would be in their account, that would be a much higher return, 6.7%. So that compounds over long periods of time and can make a really big difference. And so it is a way to save thousands of extra dollars for your child if you're contributing regularly.
Yeah. Obviously, of course, if your goal is to save for your child's first home or their retirement.
That's right.
Okay. Yeah, that makes a lot of sense.
But there are a couple of caveats. Firstly, you're saving for your child. This is not saving for you in a more tax efficient way. Secondly, it is only for their first home, or generally speaking, only for their first home or retirement.
Yeah.
And thirdly, forgotten the third point, but perhaps you recall?
No, sorry.
Okay, blank. Moving on to the next question then.
That's all good. So perhaps closer to my end of the life stages. So I'm interested in retirement. How much do you think I should be contributing to my KiwiSaver to have the sort of retirement that I would like to have?
Massey University does a good sort of report on this each year, and what they've found based on the most up-to-date cost of living numbers is that for a couple living in a main city, Auckland, Wellington, Christchurch, they would need to save around $755,000 on top of the money that they're going to get from New Zealand superannuation. Because what the university has identified is that in order to live a flexible, a choices sort of style retirement that you can have treats and trips overseas and things like that, you need to save more than what superannuation is going to give you. And so $755,000 is the number that they came up with. For a more basic retirement, for a couple living in a main city, this would require much less, around $191,000. But there is a range, and it really depends on people's lifestyles and what they're going to want, to need, and do in retirement. And so to understand how much you need to save personally, we have a calculator that uses these sorts of numbers from the university on our website. It's called the MAS KiwiSaver Retirement Calculator, and
awesome.
Check it out today.
Fantastic. Thank you so much, Jules. Really, really good to hear your responses. Those are the sort of questions that our advisors get asked all the time. So please do remember we've got those advisors out there around the country that can help. Now, we do have some questions from you, the audience, as well, which is fantastic. Thank you. Please do keep them coming. A bunch of them are actually for you, Phil. So we might give you an opportunity to chip in as well, if you wouldn't mind. So should we give you there's a few. Should we give you a relatively easy one to start off with? So sure. You can take your pick, but I suggest, what's your outlook for value shares versus growth shares over the next decade?
No, it's a very good question. I think, again, to that investment textbook point that I made earlier, if we look back at the last cycle, textbooks teach you that valuations matter. Now, for those that maybe don't understand the question, perhaps I should explain it, where value investing is you're buying into companies that look attractively valued on different metrics. Growth investing is investing in companies that maybe look expensive but have got strong earnings potential. So when you look over a very long period of time, value investing has historically done better on average, except the last cycle. In fact, by magnitudes. Growth did far, far better. And again, that's the point around the US tech sector. And the macro backdrop helped that. Why was that? Well, we were in an environment where economic growth was modest, mediocre, not that strong. So if a company's actually growing earnings by 20, 30% per year after year, investors are going to value that because you can't get growth anywhere else. Now, when I think about the environment over the next 10 or so years, like I said, I think we're going to be more volatile. I think growth will be still pretty mediocre. So yeah, if a company's growing earnings, that's still an attribute I'd like, but it also matters about how stable those earnings are. And so I wouldn't say I prefer value over growth, but I would say I don't believe the next cycle you're going to see one dominate over the other one, growth over value, like we have in the last cycle.
Yeah, okay, that makes sense. Thank you, Phil. So we've got one here. How have the changes that you've made to the current conditions, been reflected in better performance for the MAS funds?
This year has started, like I said, better from a broad financial markets perspective. One thing that the MAS funds are naturally structurally overweight to, but also we've added a tactical position there, is in fixed interest. And so fixed interest this year has performed better. Now that partly is just because of the running yields now on offer. So we think back last year, fixed interest was a tough asset class. Why was that? Well, one, central banks lifted interest rates very aggressively. So there was what we call mark-to-market losses on your existing bond portfolio. But coupons were kind of 1, 2 or so %. Like I said, now we're seeing like quality companies in New Zealand, but globally issuing bonds with coupons north of 6%. So that gives you a much greater buffer to deal with any future volatility in interest rates, which there will be some, because like I said, we don't know where inflation's going, but that running yield is attractive to us. It provides that source of return and income without having to take undue risk. And so the MAS funds have benefited from that, but have also benefited from a better start to the year for tech companies and not so much the energy stocks, because clearly, because of MAS's responsible investment policies, it doesn't typically invest in fossil fuel companies, whereas I said at the start, they were really the only place you could have hit in last year. So the fact that the markets haven't started this year with energy racing away and tech underperforming, that's also been a tailwind.
Awesome, we've got plenty for you.
So bring it on.
This is an interesting one actually, and it's a bit apples and oranges, but let's ask it anyway. So banks are currently offering 5 or 6% for a 1-year term deposit. So that's not quite a KiwiSaver or retirement savings option, but nonetheless. So is this an attractive option for people who've got a short-term return sort of horizon or investment horizon? And I'm interested in either of you's views.
Well, I'm happy to start. Look, again, with caveats around not personal advice, but I suppose, look, yes, in some ways, yeah, like a 6% return, which is relatively risk-free, is relatively attractive. And that's a high hurdle for, say, equity markets to meet at the moment. I suppose the one drawback with term deposits is illiquidity. You are locked in for a year. So whereas if you were invested in or had that cash on call earning, not much less than for 6 or 7%, you could maybe get 4.5%, 5% these days. That gives you the flexibility to take advantage of the volatility that's out there. So if there's any weakness in equity markets, if there's sectors or companies that you've quite liked that fall in value, then you get a decent entry point. You can use that cash to take advantage of that. And it's likewise the same within the domestic bond market. As these quality bonds are being issued, you can use the cash on call to lock in for a return like that for even a longer period.
Yeah.
So there's a bit of give and take here, and again, it depends on your personal circumstances. But yeah, the one drawback with term deposit is clearly you are locked in for a period that reduces your flexibility.
Absolutely. Jules, anything to add on that?
Only that they are, cash or term deposits or bank deposits at the moment are really attractive assets over the short term at the moment, and they have higher interest rates than they have done in previous years. But it all just kind of comes down to what's your investment goal, what's your investment time frame, because equities have outperformed cash materially over long periods of time. And so if you're investing for the long term, you shouldn't be all in cash and hoping it's going to outperform equities over decades into the future, because that wouldn't be realistic if we look at through history. So again, just keeping that in mind, really sensible asset for short term, not necessarily for your retirement or for decades into the future.
Okay, thank you. Another one for you, Phil. I have a share portfolio which I manage myself. Should I be diversifying into another asset class this year?
Well, if you're just in equities, and again, I don't know your complete personal picture, but I think there, like I said, that's that Tina and Tara argument. There are now alternatives to equities. If you're reliant on a source of income, there's ways to get that income in a relatively riskless way, or at least low risk way. If you're looking for growth, there's alternative assets as well. So I think the answer to that is yes, there is, but again, it depends on your own personal circumstances. So it's a little tricky to answer that without knowing a little bit more detail. But Tara, is the new saying in the markets at the moment.
Yeah, okay, that makes a lot of sense. All right, so I'm just wondering if we go to that advisor one. So there's a question there for you, Jules, then. So just how holistic are MAS advisors in their advice? So is their advice essentially, is it right across the various asset classes and vehicles that people could invest in, or is it more limited to the MAS products?
That's right, it is. It's limited to the MAS products. So MAS advisors will advise on MAS KiwiSaver scheme, MAS retirement savings scheme, and then all our life products as well. So life insurance, income security, trauma, recovery, those sorts of things. So no, they don't go and advise on direct shares or annuities or all the other products available in the market from other providers and do comparisons and things.
Yeah, okay, thank you. But I think, as you've said, it's important to understand that they are able to help with insurance products as well as investments.
That's right.
Okay, thank you. So Phil, here's one on passive, and I know that did feature a wee bit in your presentation as well. So this person's asking, look, there's plenty of evidence now that passive or index funds can outperform active over the long run. Tell me about SPIVA. This person's mentioned something called SPIVA, including during the 2000s. So would we consider, so that I suppose the second part of it is, well, perhaps we can answer then, would MAS, or would you recommend MAS invest in passive funds, given the significant swing that some of the providers, I suppose, have made to passive?
Yeah, so no, it is a great question. Again, going back to the macro backdrop and why passive has emerged. One, obviously, it's technology's helped and things, but also the macro backdrop has been very conducive to passive investing, with equity markets generally doing well overall, very low dispersion in returns. So what I mean by that is, didn't matter if you were in stock A or stock B, both went up generally pretty well because the whole market typically did very well. So why was that? Well, we have an environment of modest growth, low stable inflation, and falling interest rates. So that was very conducive to that trend. Now, I just think in the next cycle, when I think about those attributes, are interest rates going to continue to fall? Well, probably not to the levels we got to last cycle. Is inflation going to be this level forever? No, I don't believe so, and I hope not, because central banks will get it down. But I think it will be higher on average, and I think there'll be more volatility. And more volatility means more dispersion in returns. So it's going to matter if you're in company A versus company B. And you don't get that choice when you're investing passively. Yep. So you've obviously got to back an active manager to get company A right and not own company B, and that's the challenge with active investing, of course. But I think the macro backdrop's going to be more conducive to that. But what I would say is MAS actually do kind of a bit of a quasi approach. So within their global equities portfolio especially, the majority of their global equities are relatively passively invested with a very active, responsible investment policy. Yeah. But the majority of it actually tracks a passive index where there's a satellite portfolio that then puts on top of our active calls. But so it's kind of the best of both worlds, I suppose you could argue. Yep.
Yeah, perfect. Thank you very much. So I'm interested in this one. So perhaps for you, Jules, I'm retired and I have funds invested in a few places, so I have a high risk tolerance. So do we think that he should, and this is, we can't offer personalised advice, so on the basis of that small piece of information, should that person be switching to something more aggressive, from something more aggressive to something lower risk?
And again, just to reiterate, unfortunately we can't give you personalised financial advice. There's a few things to think about here. So the general advice is, what is recommended by the FMA, for example, and others, is, or the New Zealand Society of Actuaries, is a conservative fund or a balanced fund in retirement. That's the general advice. Now, retirement's a really long time, right? So, you could be in retirement for 3 decades, depending on how long you live and when you retire. So you need that exposure to growth assets in order to maintain that growth over time. So if your risk tolerance is conducive to a higher growth and higher risk funds, then perhaps that could be right for you. But there are other things to think about. Your other investments, how conservative or risky are they? And there are a few things that you need to think about in terms of like a broader financial picture for yourselves and your family.
Yeah, I think absolutely. Thank you for that. It is really complex, isn't it?
It is.
And of course, not only your long-term time horizon is different, but you need to be dipping into that money.
That's right. That's right.
Presumably to fund your retirement. So, and of course, we can't give personalised financial advice. So that was just general information. So, Phil, back to you. Do you think with such high valuations in equities in the last decade that there's a reversion to mean in the next decade or longer?
History teaches us that valuations are cyclical.
Yeah.
Now, there are ways for valuations to change. Prices fall, which is the painful way, or earnings grow. Because remember, in most ways, or typically a traditional way to value a company is price value versus earnings. So, but it's not every market is expensive. New Zealand, New Zealand's expensive. I'd argue for probably good reasons at the moment, because it's a defensive market, it's quality, people are willing to pay for those attributes, as would I. You've got the US market, which looks expensive. But there are cheaper markets out there, which I think are looking interesting. So whether that's Europe, the UK, even parts of the emerging world. Now, again, you've got to have a risk lens over that and how you create a whole portfolio and balance those risks to make sure that you've got all the attributes and the diversification that you'd like. But there's ways to position portfolios to take advantage of some of those valuations that are offered. And like I said, within some of the portfolios from a global perspective, we are actually starting to tilt away from the US at the moment and arguably underweight in market parlance because of that valuation picture.
Yeah, thank you. That's a really good point. Thanks so much for that. Here's a very recent one. I love these live events. So how have the recent, Phil, the recent 2 US bank collapses affected MAS investments?
Yeah, I think it's worth stepping back, perhaps. And I think this is a great question. It's very topical. Why has it happened? And I think the reason we've seen these cracks starting to emerge in the financial system, and there's a saying in financial markets, is that central banks tighten or hike interest rates until something breaks. And it has actually been quite remarkable that nothing has really broken just yet until obviously the last few days, maybe outside of the crypto space. And you've seen, like I said, probably the second most aggressive tightening cycle in US history over the last 12 months or so. And you're only now starting to see a few cracks in the financial system emerge. Now, I think they're not systemic. While the situation's very fluid, and I've got to be careful that things don't change while I'm even speaking, but it's been quite a unique situation with these 2 banks. They were exposed to startup tech companies, so the IPO market, which was very frothy during the COVID pandemic, and the crypto space, which was also very frothy during the COVID pandemic. So those are areas where you'd almost expect to see some strain starting to emerge. And it's quite funny when you think about what causes banking crises. Usually it's around shoddy lending practices or lending to an industry that goes through some struggles. That wasn't really the case this time around. It was all around their deposit base. Their deposit base was very uniquely structured into really 1 or 2 industries. And as those industries struggled and their depositors removed those funds, the banks were left with a liquidity problem. Now, we've seen policymakers step in with quite an aggressive response and backstop. So I suppose they've learnt the lessons from the GFC is to not muck around. When there's a kind of a crisis of confidence emerging, you act fast. And they have done that. And I think that's an important step that should, in theory at least, help cushion any contagion risks. When I think about how's it impacted on the MAS funds, MAS did have a very small exposure to Silicon Valley Bank, and I've forgotten the number there, Helen. I know you know it.
I can tell you. So the average across the funds is 0.015%. The most exposed fund was global equities, no surprises, which held 0.022%. So a very minor exposure.
Yeah, And again, it's important to remember that the funds are highly diversified across different assets and different asset classes. And we've seen, because of the risk aversion and the concerns around what this could imply, quite a movement in bond yields. And that's, if anything, going to actually act as quite a cushion for the MAS funds given this volatility. So yeah, small direct exposure. The recent episodes, together with my concerns over kind of the growth outlook and in tight labour markets and these latest financial stability strains, reinforces kind of my view, we need to be cautiously positioned, which we already are in the MAS fund. So I think they're set up in a relatively good way to try and counter what is, like I said, a lot of volatility.
Yeah, absolutely. Thank you. Really conscious of time. This has been fantastic. We've got perhaps time for one more question. So perhaps for Phil, if I have a high risk tolerance and I'm investing for the short term, can you see any alternatives to equities that you would recommend?
I think I can answer this pretty easily. Unfortunately, I can't give you any personal financial advice. So it's a cop-out answer, but I'm bound by regulations.
Yeah, absolutely. And unfortunately, the same for Jules and for me as well. But look, thank you so much to everybody online and the audience. This does bring us to the end of the discussion. Thank you again for your time. I hope you found it useful. Thanks also to Phil and to Jules for taking the time to share your insights. I really enjoyed the discussion. One more plug, remember that we have a team of MAS advisors. They're based all over the country, and you can book a time to speak with them if you want to discuss anything to do with MAS insurance or investments. So you can get in touch by emailing info@mas.co.nz. So that's info@mas.co.nz. We'd love to hear any feedback that you've got on tonight's webinar. And also we'd love to know if there are any topics that you would like us to cover in future. Hopefully this is the first of many webinars to come in the future. In the meantime, thanks so much again and have a lovely evening. Bye.